Welcome. Today we are looking at quantitative easing and quantitative tightening, also known as QE and QT. Let's start with the basics. Central banks usually influence the economy by changing short-term interest rates. Lower rates encourage borrowing and spending, higher rates slow everything down. But what happens when interest rates reach rock bottom and the economy still needs support? That's where quantitative easing comes in. QE is when a central bank, in the UK's case, the Bank of England, creates new digital reserves and uses them to buy long-term government bonds. Before we go any deeper, let's quickly explain government bonds. A bond is essentially an IOU issued by the government. Investors buy bonds and in return receive interest over time. When the central bank buys lots of these bonds, it pushes up their price and lowers their yield. When the bank becomes a massive buyer, bond prices rise, long-term interest rates fall, borrowing becomes cheaper and investment becomes easier, and the economy gets a much-needed push. QE can help rise inflation if it's too low, but it's really a tool for keeping financial markets stable and supporting the economy during major downturns. A common misconception is that QE prints money, that consumers spend directly, but that's not how it works. QE creates reserves, which stay inside the banking system and can't be used by households or businesses. QE influences the real economy indirectly by lowering borrowing costs, supporting financial markets, and encouraging lending. QE first appeared in the UK in March 2009, right after the global financial crash. At the time, banks weren't lending, businesses were cutting jobs, households were spending less, and inflation was falling dangerously low. The Bank of England had already cut interest rates to 0.5%, the lowest in its 300-year history up to that point. They simply couldn't lower rates any further, so they introduced QE. The first round was £75 billion, later expanded to £200 billion. The goal wasn't to cause inflation, it was to stop the economy from spiraling into deflation and deeper recession. QE helped stabilize the banking system, lower long-term borrowing costs and support a slow but steady recovery over the following years. Fast forward 2020, the world shut down. Businesses closed, spending collapsed, financial markets panicked, and the economy shock was bigger than 2008. Interest rates were already very low, only 0.75% before the pandemic hit. So once again, the Bank of England had limited room to act. They cut rates 0.1%, the lowest in UK history, and launched the largest QE programme in the UK, eventually totaling around £450 billion. This time, QE served two main purposes. Stabilise the markets. Large institutional investors were rushing to sell assets, including government bonds. QE provided a buyer, supporting the economy. Keeping borrowing costs low helped households, mortgages, and businesses during an unprecedented freezing activity. While inflation remained low in 2020, it later surged. But most economists agreed that supply shocks, energy prices, and global disruptions played a major role, not QE alone. Now let's talk about QT, quantitative tightening, the opposite of QE. QT happens in two ways. The first way is passive. The bank simply lets bonds it holds mature and doesn't replace them. When a bond matures, the government repays it, and the reserve created during the QE disappears. Active is when the bank sells some of the bonds back into the financial markets. Both methods shrink the central bank's balance sheets and reduce the amount of reserves in the banking system, helping cool demand in the economy. The UK began QT in 2022 as inflation rose sharply. So, to sum it up, QE is used when interest rates are already low and the economy needs support. It boosts the economy by lowering long-term borrowing costs. The UK used QE in 2009 to combat the financial crisis and in 2020 to stabilise markets during COVID. QT reverses QE, shrinking the bank's balance sheets and tightening financial conditions. These tools don't directly print money that consumers spend. Instead, they operate within the financial system and influence the broader economy through interest rates, confidence, and lending. If you found this breakdown helpful, feel free to like and subscribe for more clear-headed explanations of economics and markets. Thank you for watching.